Reserve Bank, while remaining alert to these global developments, began the year celebrating the completion of 90 years of this august institution since its inception way back on 1st April 1935. The Reserve Bank's journey over the last 9 decades is closely intertwined with the nation's development and progress. As a custodian of monetary and financial stability, the Reserve Bank has evolved itself over the years into a full-service central bank with varied functions facilitating a market economy. Indeed, a very, very long journey full of accomplishments and achievements, something which every RBI is proud of, and something I believe the whole of India and its citizens are also proud of. In this challenging global environment, the Monetary Policy Committee met on the 7th, 8th, and 9th of April today to deliberate and decide on the policy repo rate. The global economic outlook is fast changing. The recent trade tariff-related measures have exacerbated uncertainties, clouding the economic outlook across regions, posing new headwinds for global growth and inflation. Amidst this turbulence, the US dollar has weakened appreciably, bond yields have softened significantly, equity markets are correcting, and crude oil prices have fallen to their lowest in over 3 years. In fact, as we speak, it is about $60 to a barrel. Under these circumstances, central banks are navigating cautiously with signs of policy divergence across jurisdictions, each reflecting their own domestic priorities. The Indian economy has made steady progress towards the goals of price stability and sustained growth. On the inflation front, while the sharper than expected decline in food inflation has given us comfort and confidence, we remain vigilant to the possible risks from global uncertainties and weather disruptions. Growth is improving after a weak performance in the first half of the last financial year, 24-25, although it still remains lower than what we aspire for. And now I come to the decisions of the Monetary Policy Committee. After a detailed assessment of the evolving macroeconomic and financial conditions and outlook, the MPC voted unanimously to reduce the policy repo rate by 25 basis points to 6% with immediate effect. I repeat, the MPC voted unanimously to reduce the policy repo rate by 25 basis points to 6% with immediate effect. Consequently, the standing deposit facility, the SDF rate, under the liquidity adjustment facility shall stand adjusted to 5.75%, and the marginal standing facility rate, or the MSF rate, and the bank rate shall stand adjusted to 6.25%. I shall now briefly set out the rationale for the decisions of the Monetary Policy Committee. The Monetary Policy Committee noted that the inflation is currently below the target. It is supported by a sharp fall in food inflation. Moreover, there is a decisive improvement in the inflation outlook. As per projections, there is now a greater confidence of a durable alignment of headline inflation with the target of 4% over a 12-month horizon. On the other hand, impeded by a challenging global environment, growth is still on a recovery path after an underwhelming performance in the first half of 24-25, which is the last fiscal. In such challenging global economic conditions, the benign inflation outlook and the moderate growth demand that the MPC continues to support growth. Accordingly, the MPC unanimously voted to reduce the policy repo rate by 25 basis points to 6%. Moreover, it also decided to change the stance from neutral to accommodative. It also noted that the rapidly evolving situation requires continuous monitoring and assessment of the economic outlook. Let me now dwell a little on the monetary policy stance. This has been a subject of interest for some commentators and market participants. There have been questions as to whether it means a change on the policy rate or whether it signifies our stance on the interest rate or whether it relates to liquidity conditions. From a cross-country perspective, monetary policy stance is typically characterized as accommodative, neutral, or tightening. While an accommodative stance entails easy monetary policy that is geared towards stimulating the economy through softer interest rates, tightening refers to contractionary monetary policy, whereby interest rates are hiked to restrain spending and curb economic activity, all with the objective of reining in inflation. A neutral stance is typically associated with a state of economy which neither calls for stimulating economic activity nor calls for controlling inflation by curtailing demand. Therefore, it provides the flexibility to the central bank and the MPC to move in either direction on the basis of the evolving economic conditions. In our context, the stance of monetary policy signals the intended direction of the policy rates going forward. Accordingly, with respect to the policy rate, which is the mandate of the MPC, today's change in stance from neutral to accommodative means that going forward, absent any shocks, the MPC is considering only two options, that is status quo or a rate cut. Let me also clarify that the stance should not be directly associated with liquidity conditions. While liquidity management is important for monetary policy, including decisions related to policy rate, it is an operating tool with the RBI for various purposes, including monetary policy transmission. Monetary policy decisions to change policy rates do, however, have implications for liquidity management, being the operational tool to carry out the policy changes. To summarize, our stance provides policy rate guidance without any direct guidance on liquidity management. I will, of course, be discussing later our approach to management of liquidity. Before now I share our outlook and assessment of the growth and inflation, I think a few words on the implication of the recent global trade and related policy uncertainties are in order. Let me first highlight the possible implications for growth. First and foremost, uncertainty in itself dampens growth by affecting investment and spending decisions both of businesses and households. Second, the dent on global growth due to trade frictions will also impede domestic growth. Third, higher tariffs shall have a negative impact on net exports. There are, however, I may say, several known unknowns. The impact of relative tariffs, our relative tariffs vis-a-vis some of the other countries are quite low. Then there is the unknown of the elasticities of our export and import demand and the policy measures adopted by us. You are all aware that India is very vigorously and proactively engaging with the US administration on the foreign trade agreement. These are just to name a few. These make the quantification of the adverse impact on growth difficult. The risks to inflation, on the other hand, are two-sided. On the upside, uncertainties may lead to a possible currency pressure and therefore imported inflation. On the downside, slowdown in global growth could entail further softening in commodity and crude oil prices, putting downward pressure on inflation. Overall, while global trade and policy uncertainties shall impede growth, its impact on domestic inflation, while requiring us to be vigilant, is not expected to be of high concern. Coming now to our growth outlook. Real GDP, as you are all aware, this year, as per the MOSPI figures, is expected to grow at 6.5%. This is on top of a 9.2% growth rate observed in the previous year, which is 24-25. In 25-26, the current year, prospects of agriculture sector remain bright on the back of healthy reservoir levels and robust crop production. Manufacturing activity is showing signs of revival, with business expectations remaining robust, while services sector activity continues to be resilient. On the demand side, bright prospects of the agriculture sector bode well for rural demand, which continues to be healthy, while urban consumption is gradually picking up with an uptick in discretionary spending. Investment activity has gained traction and is expected to improve further on the back of sustained higher capacity utilization, government's continued thrust on infrastructure spending, healthy balance sheets of banks as well as the corporates, along with the easing of financial conditions. Merchandise exports will be weighed down by global uncertainties, as mentioned earlier, while services exports are expected to remain resilient. Headwinds from global trade disruptions continue to pose downward risks. Taking all these factors into consideration, real GDP is now projected for this fiscal 25-26 at 6.5%, with Q1 at 6.5%, Q2 at 6.7%, Q3 at 6.6%, and Q4 at 6.3%. While the risks are evenly balanced around these baseline projections, uncertainties remain high in the wake of recent spike in global volatility. You would have noted that the growth projection for the current year has been marked down by 20 basis points relative to our earlier assessment of 6.7% in the February policy. This downward revision essentially reflects the impact of global trade and policy uncertainties, which I had highlighted a little while ago. Coming to inflation, the headline inflation moderated during January-February 2025 following a sharp correction in food inflation. The outlook for food inflation has turned decisively positive. The uncertainties regarding Rabi crops have abated considerably, and the second advance estimates point to a record wheat production and higher production of key pulses over that last year. Along with robust Kharif arrivals, this is expected to set the stage for a durable softening of food prices. Sharp decline in inflation expectations in our latest survey for 3 months and 1 year ahead would also help anchor inflation expectations going forward. Furthermore, the fall in crude oil prices augurs well for the inflation outlook. Concerns on lingering global market uncertainties and recurrence of adverse weather-related supply disruptions, however, pose upside risks to the inflation trajectory. However, I may add that as per the latest forecast by various organizations, national and international, including our own Indian Meteorological Department, the monsoon is expected to be normal, and the El Nino effect is also expected to be absent. So these are positives for us. Taking all these factors into consideration and therefore assuming a normal monsoon, CPI inflation for the financial year 25-26 this year is projected at 4%, with Q1 at 3.6%, Q2 at 3.9%, Q3 at 3.8%, and Q4 slightly higher at 4.4%. The risks are